What if I told you that the price of a few streaming subscriptions each month could turn you into a half-millionaire? I'm not talking about some crypto scheme or penny stock gamble. I'm talking about one simple ETF, $100 a month, and the power of time. By the end of this video, you'll see the exact numbers year by year based on verified data from official sources. But before we dive in, quick disclaimer, this is not financial advice. I'm here to educate and show you what the math actually says. Always do your own research before investing. Let's start with the number that's going to blow your mind. If you invested just $100 every single month into SCHD for 30 years and reinvested every dividend, your $36,000 in total contributions would grow to $551,883. That's over $500,000 from pocket change. And here's the kicker. By year 30, you'd be collecting $43,829 in dividends every single year. That's $3,652 every month in passive income. Sound impossible? Let me show you exactly how this works. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. So what is SCHD? SCHD stands for Schwab US Dividend Equity ETF. It launched back in October 2011, and today it manages over $71 billion in assets. This isn't some obscure fund. SCHD holds 103 of America's most reliable dividend-paying companies. We're talking about household names like Merck, Coca-Cola, Cisco Systems, Chevron, and PepsiCo. These aren't just companies that pay dividends. These are companies that have raised their dividends year after year for decades. Many of them are dividend aristocrats, meaning they've increased payouts for 25 consecutive years or more. Here's what makes SCHD special. Since inception, it's returned 12.16% annually. That's the official conservative number from Schwab. The current dividend yield sits at 3.83%. And get this, the expense ratio is only 0.06%. That means for every $10,000 you invest, you only pay $6 in fees per year. Compare that to actively managed funds charging 1% or more, and you can see why costs matter. Over 30 years, high fees can destroy hundreds of thousands of dollars in returns. SCHD keeps more money in your pocket where it belongs. Now let's talk about the strategy behind SCHD. This fund doesn't just buy any dividend-paying stock, it focuses on quality. The companies inside SCHD have strong cash flow, solid balance sheets, and a proven track record of returning cash to shareholders. The fund has lower exposure to high-flying tech stocks, which means it often underperforms during market surges. But here's the trade-off. During market crashes, SCHD holds up better. It dropped 33.4% during the March 2020 COVID crash, but recovered completely within 6 months. That defensive quality matters when you're trying to sleep at night during a bear market. Alright, now for the experiment. Here are the ground rules. You invest $100 every single month for 30 years. That's 360 monthly contributions totaling $36,000. You have dividend reinvestment turned on, meaning every dividend you receive automatically buys more shares. You're doing this inside a tax-advantaged account like a Roth IRA so you don't get destroyed by taxes. And you're using dollar cost averaging, buying every month regardless of whether the market is up or down. This strategy removes emotion from the equation. You're not trying to time the market. You're just consistently showing up. Let's break this journey down decade by decade, because the progression is absolutely wild. In the first decade, years 1 through 10, you invest $12,000 total. By the end of year 10, your portfolio is worth $23,792. You're receiving $1,144 in annual dividends. Now, I'll be honest, this phase is boring. Your portfolio has barely doubled your contributions. This is where most people quit. They look at their account after 5 years, see it's not life-changing yet, and they cash out. Big mistake. The first decade is about building the foundation. You're accumulating shares. You're letting those dividends reinvest. The magic hasn't happened yet, but the stage is being set. Now we enter decade 2, years 11 through 20. You invest another $12,000, bringing your total contributions to $24,000. By year 20, your portfolio has exploded to $116,977. Your annual dividends are now $7,230. Notice what just happened? Your portfolio grew almost 5 times from the first decade. This is the acceleration phase. The snowball is rolling. Those reinvested dividends from the first 10 years are now buying more shares, which generate more dividends, which buy even more shares. The compound interest machine is warming up. Then comes decade 3, years 21 through 30, and this is where your jaw hits the floor. You invest your final $12,000, bringing total contributions to $36,000. By year 30, your portfolio has grown to $551,883. Your annual dividend income is $43,829. That's 15.33 times your original investment. This is the explosion phase. The vast majority of your wealth gets created in these final 10 years. Why? Because now you have hundreds of thousands of dollars compounding, not just the few thousand you had early on. The dividends you're reinvesting in year 25 are buying dozens of shares each quarter. This is the power of exponential growth that most people never experience because they quit too early. Let's talk about one of the most mind-blowing metrics in this entire analysis: yield on cost. When you start investing, you're getting about a 4.08% yield on your contributions. Fast forward to year 30, and your yield on cost has skyrocketed to 121.75%. What does that mean? It means every $100 you contributed at the beginning is now paying you $122 every single year in dividends alone. Your money isn't just growing in value, it's generating more cash than you originally invested year after year after year. This is the true magic of dividend growth investing. Now here's something critical that most people miss. There's a massive difference between reinvesting dividends and taking them as cash. Let's compare. If you reinvest every dividend for 30 years, you end up with $551,883. If you take the dividends as cash instead, you only end up with $245,596. That's a difference of $306,288. Reinvesting more than doubles your final wealth. Why? Because those dividends buy more shares, which generate more dividends, which buy even more shares. It's a self-reinforcing cycle that creates exponential growth. Thank you for watching. If this analysis opened your eyes to the power of consistent investing, hit that like button and subscribe for more data-driven content. What are your thoughts on SCHD? Drop a comment below.